Okay, fourth one. Let me see if I can get through this and be done, so I don't have to record a fifth. All right, permanent differences. Sometimes there are permanent differences between financial accounting income and taxable income. Some things are just never going to be taxable, or not anytime now anyway, with the current tax laws. But so, for example, biggest example is if interest is received from municipal bonds or anything, municipal funds, they're not going to be taxable. So that's going to cause a permanent difference. Well, deferred tax assets and liabilities are only about temporary differences, those that reverse themselves. So these types of permanent differences are not going to have any kind of effect on your deferred tax asset, tax liability calculations. All right, so here you go, interest received from investments in bonds, life insurance proceeds, if a company has their executives insured. So there's some things that are obviously a heck of a lot deeper here than we'd ever be talking about in this class, but just in general, there are permanent differences, and they don't affect they don't affect the deferred tax asset, tax liability accounts. Okay. They do affect the effective tax rate, but we're not really going to go into that. I don't think it's necessary. That's something a little bit better for Tax 2 course and taught during the summer. All right, so taking a look at this one, Tanzir Trading earned municipal bond interest of $50,000. The interest is not taxable. Tanzir pays tax at a rate of 40%, which the following is true. Well, the municipal bond interest will not be included in taxable income ever. It's a permanent difference. It does not affect deferred tax assets or liabilities. So all of these answers are not true, right? The idea is that tax expense will not be affected by the muni bond interest. All right, what happens if the tax rates differ from year to year, which, as you know, they've been changing quite a lot, especially lately with the new Tax Act. All right, here we go. What do we do when they differ? Because everything we've been doing so far has been 40%, 40%, 40%. Well, now what if we do 40, 40, 35? Okay, so the idea is what you're going to do is you're going to calculate based on what you know the new tax rate is going to be. If you don't know what it's going to be, then you'll have to make the adjustment in the future. But as of now, if you were to know for sure what the tax rate would be in the future, and it's going to be a different rate, then you should create your deferred tax asset or liability based on that number. So we had so looking at our normal way of doing it, 100,000 or 100 million at 40%, we come up with the income tax payable. We don't even need the information right in this problem, just follow along. And you're looking at installment income is the temporary difference in this one. So 10 million and 30 million you'll be getting over the next couple of years. Well, 40%, 4 million, right? That's part of your deferred tax liability. And what if we know that 30 million is not at 40%, but the tax rate's going down to 35%? Well, then we would do the math on that 35%, and we would create the deferred tax liability to be 14.5. But we would have to know. It's not just guesswork. We can't say we think it's going to change. It has to be a change into law at that point by the time you make these changes, by the time you come up with these calculations. All right? All right, so let's see. All right, so this is just a summary of the previous slide, basically in words saying that, yes, you have to do it if there's a new tax law change, and that it affects income tax expense in the year that we know that it's changing, which we did. All right, because income tax expense was lower. All right, what if we, all right, this is what we've been learning. What if we reverse a temporary difference without a tax change, right? So we're looking at the reversal of that $10 million here. This is just what we've been doing, okay? You reverse the $10 million at 40%. There's your $4 million right there, $4 million reduction of the liability, and then the next year you would reduce the 14.5, right? The remaining amount. The 30 million, oh, at 30%. Wait a second, the last one was 35%. I'm confused by this one. Oh, what if we thought it was going to be 35 and it's going to be 30? I don't know, how interesting. All right. Okay, yes. So what if it became 35? That's what it is. What if it became 30% instead of 35%? We had estimated it based on 30%. So now we're going to take the 30 million at 30%. We're going to be at 9 million. We're basically saying, what do we want? This is in 2017. We're making this entry. What do we want the ending balance to be in the deferred tax liability account? Well, for now we had estimated it to be 35, but really it's going to be 30. what we're going to do, now that we've found it to be 30, we know that we want $9 million to be the ending balance in that account. We've got 14.5 in there from the earlier estimate, all right, that we'd done in 2016. So our adjustment now is going to be for 5.5 million. It's not going to be a calculation. So before it would have been 10 million at 40%, and that would have been the 4 million. That is not what we're doing. What we're doing is we're trying to say, all right, well, now that we know what the tax rate really is going to be, what should the deferred tax liability really be? So we're kind of coming at it from a different angle. We're saying now that we know that it's 30%, and we basically overestimated our deferred tax liability by saying it was 35% before. What we're going to see, so let me go back. We had thought it was going to be this. We thought this was going to be the case. That was 30 times 35, 10.5. All is nice and all kind of falls out the way it's supposed to. But it changed based on our original estimate being too high. So if that's the case, what we do is we attack it from the other end. We try to figure out what the ending deferred tax liability should really be, and we make our adjustment based on that. So income tax payable, same thing, 44 million, 110 times 40%. But the deferred tax liability, the debit to it, is based on what we want our ending balance to be. We had 14.5. We know we want 9 for the future, so our debit is going to be that 5.5. So it's just coming at it from a different direction. All right, I'm going to try to speed myself along here since we're at 6 minutes already. Multiple temporary differences. Most companies are going to have multiple temporary differences. You're not going to just have one tax difference, one thing that created tax difference. We're going to have probably several things. So let's take a look forward. What if we have multiple things going on here? So this is a really long example, and I would imagine it's in your book as well. Pause it if you like to read it. Okay, here we go. Lots and lots of stuff going on here. The idea, and I'm just going to kind of summarize here, is that you're going to look at the differences against each other, right? So you're going to look at the things that create the deferred tax liabilities and the deferred tax assets. And you're going to kind of map them out, and that's kind of what you would be doing. You'd be tracking them all individually. So you're going to come up with what the deferred tax liability amount would be. You come up with what the overall deferred tax asset amount would be. So you'd be looking at these things, and you'd probably have as many lines as you would have differences between the two types. All right. So if that's the case, here you go. You've got a deferred tax liability. You've got a deferred tax asset. You're kind of tracking them separately. So you've got deferred tax asset, deferred tax liability. It's just a matter of a bunch of them that you're tracking them separately. Now, the one thing I wanted to note, though, is if you have, at the end of this, we're going to be talking about reporting and how you report these things on the balance sheet, rather. The idea would be you would take all of your current deferred assets / liabilities and you would net them, and you would have them be whatever it would be. So, whether it be an asset or a liability, whichever had more. And you would take long-term, and you would do the same thing for those. You would net the assets and liabilities, and you would report whichever you had the greater amount of. Okay, so like in this case, let's pretend that these were both current, and these were the only ones that you had. You would then have 7.2 million in deferred tax liabilities, because you would net them both if they were current, and you would do the same thing for long-term. You wouldn't report them both individually on the balance sheet. Okay, so just kind of following along, like I said, I'm sure this is in your book. It's exactly the same things we've been doing. It's just a greater complication of them by doing several of them together. All right, NOLs is what I want to get to. Net operating losses. Net operating losses are when you have zero taxable income, right? So you have no taxable income and you even have a loss. Now, in the past, and as far as our book knows, you can carry those back 2 years and you can carry them forward up to 20 years. However, with the new tax law changes, there is no more carrybacks. It is only a carry forward, and it's a carry forward indefinitely, but you can't wipe out future income entirely. I want to say that you can only wipe out future income up to 80%. I'm not going to be testing you on that. That is new, and that, that piece of it is new. But, this idea of not being able to carry back is a new one. But I kind of get the idea. The whole idea is, simplify things. Why should you be able to carry back and dig back into your pocket from back then? We should be able to carry forward and carry those losses forward for future years. Pretty much, like I said, indefinitely. All right. So an example of the carry forwards. Hang on. So in this situation, you have a company with $125 million net operating loss, right? So that means they had $125 million negative, right? But as far as what the tax benefit would be at 40%, 125 million at 40% is $50,000. So you've got a deferred tax asset now for $50 million that you're basically carrying forward, and you have an operating loss income tax benefit of 50, right? Okay. All right, so during 2016, so what that looks like as far as the income statement, you've got the operating loss before income taxes, less the income tax benefit of that operating loss. So really, you have a net loss of $75 million because you're going to be carrying it forward, right? It's like a deferred tax asset you've just created with that loss. Okay, so here's a good example. Please go ahead and, well, read it. Hang on. So for the answer in this one, carry forward of the $100,000, NOL will reduce future taxable income by $100,000. So Plaxo recognizes a deferred tax asset of $100,000 times 40%. So you've got a $40,000 deferred tax asset, and they've got a tax benefit of $40,000, which offsets the current loss of $100,000. So now it's $100,000 less the $40,000. So really, they'll report a loss now of $60,000 because their loss created a benefit. Okay, so I don't know that I want to go into detail on the carry back and carry forward since that's not going to be the way it works anymore, but just to kind of give you an idea, this $125,000 loss or $1 million loss, they were able to carry it back 2 years to a previous year where they had made $20,000 and $55,000, and those were the tax rates in those years. So this was the refund they're basically going to get from the IRS when they turn around and say, hey, we're going to carry those back for those 2 years. And you're going to, since they've used $75,000 of that loss, they're going to carry forward $50,000 of that loss to future years. So you have a deferred tax asset for the future years. You're going to have a receivable for the income tax refund of those $29,000, and you've got that operating loss, the income tax benefit of $49,000, which again is a plug. Okay, so like I said, I don't want to get too much into this, but the idea is instead of in 2016 you had the $125 million loss, however, you've now offset that against the $29,000 of refund and the future tax savings for future carry forward of operating losses. So really your net loss has now just gone down to $76,000. All right, so, all right, I don't want to get too into this. All right, I'm just going to go forward. Financial statement presentation. So I'm going to let you guys read through these on your own versus the painful of listening to me read to you. You can read it to yourself. The idea is that you are disclosing all of these things in the financial statement. You're disclosing your breakdown of your deferred tax assets, your deferred tax liabilities, and your NOLs. You're going to report them all. The last thing is inter-period tax allocation. Just to note, we do separate, since this is a chapter about taxes, and we'll get to the next slide, we do separate out the losses from or the taxes on things like income from discontinued operations. So for example, let's say we're getting rid of a segment or something, we're discontinuing operations. So we're getting rid of it. Here's examples of gain or loss on disposal of some arm of your operations. So if we had $100 million, but the operations made $10 million, we're going to pull those discontinued operations out of there. I'm trying to talk to you quickly. We're going to tax ourselves on the $90 million, and we're going to show income before discontinued operations. And then net down here, we will show the gain on disposal of those operations. So that would be the $10 million less the $4 million of income tax expense, and we're at $6 million. That would show net income of $60 million. The idea there is simply that we do extract our taxes and report them separately for things like discontinued operations because we don't want our tax number to include everything if we're getting rid of it in the future. All right, I hope that was enough for you. It was enough for me this afternoon. Good luck with the chapter, and I'll talk to you soon.